to learn how to beat the market maker and trade in line with him. All right, so to beat this guy or these group of guys, you got to understand their objectives and what they do. Their first objective is to induce traders to take a position. How do they do that? They circular trade, which means they trade between them. They trade from bank to bank, back and forth. They produce wide range swings. The swings create some type of activity in the market, even though there's really no volume behind it. Your account is of no use to him. You making a deposit of FXDD is of no use to the dealer until you click the mouse, until you take a position. So his job is to induce you to click the mouse by showing you something on the chart that gets you to take action. Usually he sets up some type of textbook technical that you've read about, or a breakout system, some type of behavior to get you to click the mouse. Their second objective is to create panic and fear to get you to think irrationally. Now, I talk about the illustration as they spike the market quickly and pull away from those zones, which validates the pending orders or gets people going in the wrong way. That quick move or spike or inexplicable price behavior out of nowhere, they spike the market on a Friday afternoon right before the close. That creates a panic in you. And if you're in a position when they snatch the market away from you, that creates a panic, gets you to lift your stop and think irrationally. That irrational behavior ensures that they will margin you out or eventually get you into trouble. And finally, what the business is about from the beginning is the money. So they got to hit the stops and clear the board. And if you lifted your stop, they're going to drag the market in such a way that it forces the majority of the traders into margin issues. Because the bottom line and the most important objective is to pocket your money so they can get their Christmas bonuses. Okay? All right, am I going at a good pace? Okay. In order to beat this guy, you got to know what they're capable of doing. These slides were given to me out of a textbook in the back office in Dubai called the MetaTrader 4 Manager's User Guide. Okay, what? You're saying you didn't know they had a book? Did you think that $4 trillion is floating around without a book or some type of idea on how to beat the traders? Somebody wrote a book on how to take your hard-earned money away. The business is not random. Okay? Market makers can issue you a requote at will. You see the three buttons in the center: return, send, confirm, reject. They simply hit the reject button and you are forced to reissue your order, which in turn, the market's moving, you get requoted at the new available price. Keeps you from getting a good fill, getting a good entry. Market makers can trigger all the stops in a range. Left arrow says stop out, check the box. The right arrow, unlimited, across the board. We got X number of contracts in open float. At this price point, we want to hit the stops. They simply add that, hit OK. Notice it's in different languages. They hit it. Done. They got what they need. Market makers can toy with the spreads. You know those robots that work so wonderful in demo that are garbage? This is why. In demo, you get an aggregate of about 3 feeds, 3 price feeds. The aggregate of the 3 feeds is going to be much smoother than what you're really up against on a real account. In demo, since it's not real, they could care less about manipulating the spread widening the spread to pick up the stops. They don't care. So what happens is you spend $97, which by the way is the refund price point for ClickBank. You spend $97 and buy a robot. Anything over $97, they got to give you a refund. Anything under, they do not. You own this robot. You put it on an account in demo. It makes $10 million in 25 minutes. You're jacked. You put your hard-earned money in the account. And then guess what? They take that little slider where the arrow is and open the spread on you. You'll pick up your buy side of the order, and the sell side or the opposite closing position side will never hit. There's a lawsuit right now, I believe it's with FXCM, that states this exactly. I think Abo sent it to me, and if I remember, someone reminds me with an email, I'll post it in the forum. Since it's a private forum, I could say the name, I guess. Can I, Kim? I don't know. The dealer is being sued for having these backside plugins and using these against the traders. Now, I want to say that not all dealers use this. There are some honest dealers out there. Usually the ones that are backed up by banks, or I know Kim and Scott represent good, clean dealers. But what I'm telling you is that this kind of crap goes on. That's why the NFA is trying to regulate this business and clean it up a little bit. Okay, did you ever open up two different platforms and notice that maybe one high of the day is 23.55 and another one is 23.57? Do you understand that the dealer can hold a price point with this plugin right here? Here's how. He can set the high, low, and close on a bar based on where the orders are. So if the dealer sees stops at 23.59, or if he sees a bunch of orders at 23.60, he simply types in the high of the bar to go to 23.59. Let's say there's stops at 55. The dealer goes, man, we got stops at 55. Let's hit 59 and clean the board. Remember I told you his third objective is to hit the stops and clean the board? This is how he's capable of doing that. Okay, let's say there's pending orders at 23.50 or 23.48 on the low side. He doesn't want to activate those orders because he might end up retracing and going back down. He will make the low 23.52 and leave the pending sitting there and not absorb those orders because he doesn't want the negative drawdown. Okay? These tools give the dealer an edge. And understanding that these are out there switches the edge back in your favor. They know who's in margin trouble. Ever do something stupid and lift your stop and get yourself flashing red and black back and forth because you're on the edge of margin? He knows this. He has the whole list of who's in call-out trouble. It's on his desktop. There's a trade designed called a straightaway, which I'll discuss here this week, to finish these guys that are on the fence and call them out and take the balance of their account. It's up to you to know the call-out level of your dealer. You guys that are overseas, certain dealers have a 0% margin call. That means they could take every penny from your account. Some have a 25, some have a 50. They could even take the front side margin that you're using to hold your positions open. You need to understand this. Understand that when the traders are in trouble and these margin call levels are on the fence, the dealer will issue a straightaway trade to finish these people off. And that's where the straightaway trade comes in. And that is the only reason it comes in, is to take the money from the traders that are on the fence and flashing red in their account. Someone's asked me if I said something about FXCM. Do you work for them? Because if you do, then I won't say it again. Oh, I had to get a sip of Diet Coke there. Market makers manage risk against the open positions. Look at the summary line on the bottom of the slide. Listen, it's a business. They're in business to make money. Send me an email. I'll talk to you about FXCM. They're in business to make money. They're not in business to see you succeed. You're in business to make money as a trader. They're in business to make money as a dealer. That's the way it works. In order to trade the right way, you have to be in line with the dealer, and he's not going to come back for Fred for his one order. They're not going to move the whole market back to get Ben. It's just not going to happen. So trading in line with these guys gives you a major edge. This is every plugin I just showed you on the account manager's desktop. Anyone that runs this platform has this. And I'm going to show you a picture of what they're looking at in a minute, or what the room looks like. This is what they see. They know everybody in margin trouble. They know the open orders. They know their open positions, how much equity they have as a dealer to work with. Listen, some of you are upset about accounts. Contact Kim and Scott at Compass. They are the IBs for a couple of good dealers. They will get you going in the right direction. All right? Enough said about that. Contact those guys at Compass. That's why they're here, to aid you guys in getting good accounts at clean dealers. Okay. The account manager's desktop. He knows everything that's going on and the accounts that he's managing. You have to understand that this is what you are up against. Guys, ever seen this before? It's been floating around. This is one of the rooms at UBS. But UBS is not the only dealer that has a room like this. Each one of those guys is managing their risk, monitoring their equity, and looking after the customers. All right, I want you to understand that this is not a game or a hobby. The dealer is lying in wait for you to make an uneducated, emotional decision such as lifting your stop loss or over-leveraging your account. If you've been kind of half-ass trading the business and treating it like a hobby, I encourage you to take up photography. It's cheaper. But if you are serious and want to trade in line with the dealer and can master the principles I'm going to show you this week, this stuff that I just showed you about the dealers should be irrelevant to you and unimportant if you could identify his behaviors and follow what he's doing. Okay? Okay, so how do we beat these guys? We have to understand where they set up their moves and what's going on. They make some trap moves. Those trap moves start at the beginning of the week, Sunday going into Monday. Edwin, you might have to log in and log back out. Okay, look, a lot of people are saying I'm having problems. Can you, in fact, see how to beat the market maker slide trap moves? Just throw a couple of Y's up there. Don't go crazy. Okay, fantastic. Thank you. The trap moves are made at the beginning of the week. Why? They'll jam you up and hold you in open position from Sunday, Monday. The beginning of the day, 5, 6 o'clock, when they set up the channel, the market maker spread, they already have some number of jammed up traders. The beginning of the session, at London Open and US Open, there was a false move to jam up the traders in both sessions and to end the day jamming you up. The end of the session and the end of the week. Friday, they will make an aggressive move and pull back against that move to trap the traders into weekend carry. Okay, I'm trying to keep it a little slower so you can write. So think for a minute. They make the false move at the beginning of the London session. They run the trend. At the end of the London session, they will make one more extension, which is false. Then pull back, go into consolidation for the U.S., and then possibly reverse. End of the session, continue with the trend. Beginning of the session, hit that number again, don't break it, and come back. The end of the day, 4 or 5 o'clock in the afternoon, or if they end the trading day at noon, which a lot of times they do, the price will go back into consolidation, which is the end of their day, and leave you jammed up into the next day. Now think for a minute that I've told you this, that they make these trap moves at those times a day. How many times have you sat there at 1 o'clock in the afternoon all the way into the next night, aggravated that there was no movement in the market? You got jammed up in the consolidation zone and had to sit there until the next night London opened when something started moving again. The beginning and the end of the day is defined as 5 o'clock New York. The end of the day is 5 o'clock New York. It's a 24-hour cycle. I'm going to illustrate it for you in a second here in detail. Understand that the pattern presents on a larger scale throughout the course of the week. Okay, some of you just installed the indicators. I'll give you a brief update on it. These double tracers right here. Let me grab my little ballpoint pen. I'm excited. Okay, these little tracers right here and right here. These two lines. This is Friday. This area is Sunday. This is Monday. This is the beginning of the week. The double black tracer is the beginning of the week. So here you have the week beginning. Market makers make the aggressive move to trap the traders long at the beginning of the week and then pull the market away from those traders. There's your week beginning trap move. In fact, this move just played out in most majors across the board on Monday. They made a triple top high and jammed all the traders and the bottom fell out. My traders caught that move. And I know what happened on the recent one is they made the high Friday. They came back, hit it again in Asia. And at the London Open stop hunt cycle, they hit it again. So you had a triple top high lined up with the London Open. Yes, look at the majors. Sunday, Monday. Okay. Beginning of the session. Right? I said beginning of the week. Sunday, Monday, they'll make a jam move. Trap the traders long for the week. The beginning of the session. Stop hunt in both directions, which triggers the pending orders. Right? Breakout traders, bracket this. Nice, right there, grab the pendings. They pull back, stops out those breakout traders. They hit them again. They come back, don't allow them to see a profit. Shift the zone off of those traders. Game over. You got whipsawed long and short in one session. And if you don't have the guts to come back the third time, and a lot of people do not, you're jammed and you miss the trade. Okay? So now you know when you're looking for the false moves. End of the week. Here's Friday, right? Here's my double weekend tracer. Friday, Sunday, Monday. Okay? Here's Friday. Before they end the day, they spike the low, pull back, end the week in consolidation chop. The lower level shorts are jammed for the weekend and got to pay rollover. Right? To add to the beginning of the week, they open with a gap. They didn't used to gap a lot in Forex. A couple of years ago when people got their butts kicked in equities, they started flocking over here in droves to the Forex market because of the leverage and the ease to trade. You don't have to memorize 150,000 stocks. There's a handful of pairs that you can work with. The Forex market started sounding very appealing to people that lost their pensions. Now, because there's more volume, these guys added a gap to their arsenal against you. So what I'm telling you is, in not so many words, or in too many words, don't carry your trades over from Friday into Sunday, Monday. Not necessary. If I told you they're going to jam you on Friday and leave you trapped, and you caught this M in the U.S. session and you shorted here, and you see the hammer to the low and it pulls back, take your money off and call it a good week. Okay? End the day in consolidation, end the week off of the high, 25 to 50 pips to jam the traders, depending on the pair, and I'll talk about that in a minute. Okay? Good stuff. Another Friday example. They went up to the high. Friday, Sunday, Monday. Here's your formation. Here's our entry in our group. This might have been a scratch because you have a big entry bar. We might add a pass on that. I know Jim Nicholson got in right there, though. Okay. If this bar is too big, this is a pass. This is a no entry. Okay, now, here's the gap I talked about. This looks like buy the dips in an uptrend, right? So people got jammed up all in here. Friday, they closed, they stuck them because people thought the market would rally at the end of the day, right? Whatever the philosophy is. They gapped down, hit the stops that were all in this range right here, and all these guys that were stuck long in here, they gapped them right out with this, hit their stops. Now, the shitty thing about the dealer that he can do about that is this. If the dealer closes at a price point on Friday and he gaps down 100 pips or 80 pips or 50 pips and opens, if your stop was 5 pips below the candle, he gives you the fill at 45 minus 45. How can he do that? I had an order in minus 5 or minus 7. The answer is that is the first price available on Sunday at the open. You were filled at the first price that was available at that level. So you thinking you have a nice stop in place and carrying stuff over the weekend is crap. If this has never happened to you, I applaud you. If you thought about carrying trades into the weekend, this is why you do not. You don't know what's going to happen with the economy the way it is. You don't know if they're going to raise the debt ceiling, lower the debt ceiling, fire the president. You don't know what's going to happen. You don't know if there's going to be some mass exodus in the Eurozone to get out from underneath the euro and there's burning and buildings collapsing over there. You don't know if there's going to be an earthquake. Market makers use that crap as the opening reason to gap the market aggressively against you. It's crap, but it doesn't give you back your lost equity when you hold a trade over Friday. I've seen gaps come all the way back to the low. I've seen sick stuff with the gaps. So what I'm telling you is, in not so many words, is don't carry trades from Friday. Take what's given to you and get out.